Good morning and good afternoon. David Balin and Stephen Whiting from New York City reporting on The Point. This week's broadcast, shocks versus bear markets. What's the difference? Lots of news around AI and its impact on markets, especially on the software sector, where we've seen an indiscriminate sell-off of about 20%. We'll talk a lot about the difference between what happens when there is a big shock to markets and when there's a revolutionary change in technology that's going to cause profits ultimately to rise for all businesses, but an enormous amount of disruption associated with what will happen to industry and to labor as AI begins to have large impacts on our economy. We've seen lots of stocks do well. Stephen will talk a little bit about this. Software shares are down, 20 to 30%. Office REITs are down. We'll talk about what parts of the markets are up and what that indiscriminate sell-off looks like. One of the other things we're going to talk about are the properties of bull and bear markets and how to begin to prepare portfolios for them by changing their actual construct of what's in them. And a lot of that is reflected in CIO Group portfolios. We've taken profits in areas like aerospace and defense. We've added some defensive sectors in MLPs and REITs. And we're going to talk about how we go about thinking about the future and how we build portfolios in a second. So, Stephen, why don't you give us a little bit of backdrop on the next slide about what is exactly going on and why we should be focusing on this in a little more thoughtful way.
So some of the things that we wanted to share with you today is that we've got areas like software, which are the best performing industry group in most of the last 4 decades, has very little variation in what's happening. Shares like Workday and Salesforce are down 30%. Meanwhile, cybersecurity shares like Palo Alto are down 20-25%. And they're in very different businesses. But what we're seeing in the marketplace is not a view that AI is just taking down everything. This is not Terminator Judgment Day. We're seeing memory chip makers and the energy infrastructure that's going into AI going up in price. So what we're really seeing here is a view in the marketplace that AI is going to be effective in reducing business costs, whether that's software inputs that companies have to spend money on or people. Like you just mentioned, we have office REITs down, but we have broader REITs up. So that's an important distinction. We'll also talk about shocks later. But on the next page, you could just see that there is a lot more spending going on. We just saw an increase of $94 billion in just 4 large public companies in terms of their capital expenditures going up just compared to just 3 months ago.
And what's taking place now, I think, is extraordinary because this level of infrastructure build, right, reminds me a lot of sort of the build out of fiber across the US, except this is much faster in terms of the amount of dollars that are being spent. And it's requiring an enormous amount of capital, not only equity, but debt capital. We've seen a bunch of issuances over the last few weeks about that. This level of spend indicates the degree of confidence that these large companies have in the impact that AI will have on their businesses, right? Microsoft and others are expecting enormous amounts of growth in their own income for having built this infrastructure. The impact of AI on businesses, this incredible efficiency that it's going to drive, and the ability to actually substitute one type of programming for another that Anthropic has talked about is what's driving this dislocation in markets. So are we seeing the end of software leadership? We don't think so. We think it's going to be a large shakeout in the industries, those companies that have staying power, that can incorporate AI into their businesses are going to get revenues, and those that are actually specialized or don't have the ability to actually advance are going to decline. But right now, as Stephen mentioned, everything is in decline. So let's everything in software. So let's take a look at the next slide.
So just wanted to think about some of these businesses. Microsoft is a company that has a massive cloud business. And the AI infrastructure and all of the applications and uses exists on the cloud. And so why is this share down the same as, again, some of the companies that are just specializing in things like IT services, HR, and employment, things that are going to be displaced? But what you can see here is that there are big areas of improvement in the marketplace with the build out in AI. Memory chips, some of our exposure to the Korean companies like Samsung and Hynix, for example, are appreciating there. even after last year's boom. NVIDIA will report next week. They're a part of the spending. And unfortunately, when we get to the difference between booms and shocks, all of this is really the boom spending. But that right picture is so different from the other one, where all of the software shares are moving together. Different aspects of hardware are moving very different from software right now. So a massive shift, probably an exaggeration in terms of the long run performance of hardware. They've got inventories to manage, and software really much in the dumps right now. This 20% correction is probably going to be because it's so indiscriminate in opportunity. It's one of the reasons why we're not divesting.
That's right. Now, let's take a look at one aspect of this that I thought was interesting, right? IT and consulting services, which is the largest human employer, and application software have equally fallen. And that to me tells you that it's indiscriminate, Stephen, because if you think about it, one is displacement of labor. That makes sense. Displacement of all software, not so much. Let's go to the next slide. So tech has been the largest driver of U.S. returns. And as we've pointed out in several of our publications and on prior broadcasts, it doesn't come without a high degree of profitability. The market cap of technology obviously has risen faster, right? But one of the reasons it has risen faster than profits is simply because of the fact that so much investment has gone there. But what Stephen and I are concerned about is not so much the valuations today as that the infrastructure spending that is actually underpinning the U.S. economy is actually unsustainably large. And Stephen, you had talked during one of our conversations about how much of GDP this represents and how 1 or 2% is an enormous amount and how it's unsustainable.
Well, when you only get 3 percentage points of growth in the overall economy, and 1% is coming from the building of data centers, which you can see on the right, probably this year, the data is showing another 50% gain for a third year. Ultimately, we will not stop using AI, but building the infrastructure so rapidly is going to stop at some point. And there's probably going to be some competitive forces, some company that just doesn't get as good a product, that's going to end up pulling back on its spending because someone's not going to finance the second best company in AI. And that's going to mean a reason why this drops. And you can see the ups and downs in the spending before it's going to happen again. So ultimately, this is the element of boom. The hardware sector is what's booming in the economy. The software sector right now, everyone views it as being displaced, and there'll be aspects of that. But what we think about on the next page, and we hope you're not having this this view of this chart over lunch, is the fact that equity markets have had returns that have been extraordinary in the United States. If you take a look at the last decade, it's been a 15% return. The long run compounded return is 10. So there's going to be some period, and we've arranged these into a histogram on the left so you can see those bear markets correct for it. Now, we can have pretty good visibility into the economy this year. I can believe the economy can be strong again in 2027, but the likelihood that we are going to embed a drop in the equity market, a bear market, is out there. Now, let's just look at one more slide on the next page. And if you think about the valuation of equities dependent on these continued earnings growth and the valuation of bonds, on the right slide, just in line with their long-term averages. What you're saying here really is when that moment comes, we're not thinking it's this year, but when that moment comes, the bond market is in a lot better place to handle the consequences of a bear market and profits, some decline in tech hardware.
Right, and that's the most important part of the message is that when you see these trends, the positive for 2026, right, for profitability, that's when you actually begin to build these more resilient portfolios when you see valuations coming under pressure in the equity markets. Let's go to the next slide. So one of the things that we want to talk about in diversification is to look at what correlations are. And this is a relatively simple chart. We've actually shown it before. But in the largest periods of decline, right, for the S&P, you see these pretty extraordinary moves, right, that take place also in information technology. No surprise. The largest gains, obviously, also in information technology. But what's interesting is that areas like healthcare, which have much more sustainable earnings momentum, much less earnings volatility, tend to perform less negatively during these large drawdowns. And yet, when we look at most portfolios, they lack exposure to healthcare. Stephen, they also lack exposure to long duration bonds. And that is something that I think people should be thinking about, a little bit of that.
You know, the time will be right. Right now, we think that we're getting enough interest right at the intermediate or shorter term. The shorter terms become less attractive. We've taken some moves to take variable rate product and fixed income down in our asset allocation. And we've added some really high yielding assets. There will be a time when we're going to want 30-year Treasury bonds. Now, right now, everyone is a little worried. The Federal Reserve, in its minutes yesterday, said, well, wait a second, what if we need to tighten someday? And that will come, indeed. So there are all of these concerns about long bonds, but the reality is during a bear market, this is going to be a key area in which we play defense. Gold, which has had a 70% return over the last 12 months, acted like, well, the bear market's already been here and we've enjoyed it. That's why it's not likely to operate as quite a good a hedge. Now let's just go to the next page and talk a little bit about this data. There are questions about interest rates. We have Federal Reserve members on different sides, on different aspects of this. And I just read on Bloomberg that we had a strong employment report for the month of January. So all of those worries are over. Well, what did we actually have in January? This picture on the left just shows that we had a drop of 2.6 million in employment. Well, wait a second. The headlines didn't say it. They said that we were up 130,000 in employment. Well, the reality is that most of what you see between December and January, 95% of the headline is driven by the seasonal adjustment process. Last year, we had 2.9 million job losses, and each year before it tended to be larger. There's a lot of seasonality in the economy at the turn of the year. Think about adding workers into retail stores for holiday sales. When those workers lose their temporary jobs, we have to adjust for that. So the reality is the employment data have shown a weakening trend. Last year, just 25,000 jobs per month were added. That's a downward revision from an already meager 49,000. Most importantly, what that right picture shows is that the public in the United States is seeing that the labor market is getting more difficult. It is harder to find a job. And you can see how closely correlated that is to the official unemployment rate, which went down in the month of January. The truth is, we have an economy that is seeing an AI boom with lots of spending, 50% in computer power to build data centers, and very little of that has to do with people. The rest of the economy has been weak. We don't think it will stay that way, but this is a reason for the Federal Reserve to still be very engaged from its perspective in trying to cushion the downside risks to the labor market.
I also think, Stephen, we're going to see a change, right, in labor utilization based on AI at some point. If it's not immediately, it is going to happen. And I do think that
I think it's happening in that data. That's part of last year's story.
And I think we need to be aware of the fact that we're going to be monitoring that, because that will have it. And this is really the thing that I want to talk about from an investing standpoint. You may have labor right deterioration and profit growth at the same time, and that I think is the really the underlying potential contradiction of something that people aren't used to when we take a look at actual portfolio construction, where that profit is and how to go about investing in that environment. Next slide, please. So with all of that, what we want to talk about also is that we're in a moment of volatility. This weekend, there are potential strikes that could occur in Iran. There are now 2 carrier forces in the U.S. that are there, and negotiations are underway. One of the things I asked Stephen to talk about is, what are the scenarios, right? There could be a minor scenario, but there could be a major disruption. Stephen, what is the sort of major disruption possibility? We're not talking about the probability, but if the worst case scenario, what does that look like?
So this is yet another event in markets that day to day is clouding the whole picture. So it's more difficult to read what the underlying trend is. Today, oil was up 2%. We had Iranian war games in the Persian Gulf. They closed down the Straits of Hormuz for a couple of hours. And we could see that world exports of crude oil, about 20% of all of that is going through the Straits of Hormuz. Now think about oil itself. About every 35 days, we consume about the equivalent of all of the inventories that are out there. We constantly need to pump more oil because this is a commodity that disappears into the atmosphere. So what you see on the right here, I put a left and right scale, that's tenfold difference, is that the oil price can move up $15 for every 1% drop in crude oil production. Now that turns out to be very temporary. Usually the volatility in the oil price will move up dramatically compared to the long-term supply of oil. And so these sort of disruptions can suddenly get us. Look, if Iranian's oil is not exported, we might have $75 oil. If they were to stop the oil exports of the neighboring Gulf countries, it could be $100 oil, but it would be for a very short period of time. And that's likely to have a transitory impact, we'll use the word, on markets. Now, if we turn to the next page, this is sort of a different subject, but that right picture on the over there, which was a nice picture, the best way for me to illustrate this is to look at one industry. Look at American auto production during the pandemic, where we forced factories to shut down, or if we force majeure oil production to shut down. You get this temporary drop, but then it comes right back because demand is no different. Now, those types of things represent shocks. When we take a look at the left picture, here's a representation of a boom. And booms come with busts. And unfortunately, when we think about the speed and size of some of the AI hardware investments, we are talking about boom risk. Here in the case of housing, it takes a long time to depreciate housing. I remember, in the deserts of Nevada, seeing unfinished housing as far as the eye can see. It took a decade to sell it all off. Well, that's what a real boom looks like. It has a severe negative lasting consequence on the economy. It has recessionary impact. Again, hardware in the future doesn't necessarily have to have the same impact of the subprime housing crisis, but it is very much that character, right? And that's one of the things that we have to make sure that while we invest in this profitable growth, memory chip makers, semiconductors, we want to have portfolios that are going to get exposure to durable drivers of returns that are not exposed to that boom.
Right, and that's the whole concept of a forward-looking portfolio, right? Indices, of course, naturally over time rebalance, but I think our strategy is to really lean into the things that we can identify in the data, the sectors, opportunities for diversification, and where real profit drivers are going to be sustainable. Next slide, if we can. So with all of that, as I mentioned earlier in the broadcast, one of the things we're doing is to shift up income and move away from certain return drivers that have already had some remarkable performance. On the left-hand side, you can see some of the things that have performed particularly well, right? Like utilities and real estate, these contra indicators. But that is to me much less interesting than the slide on the right-hand side. And Stephen, I love this, is my favorite slide of the week, by the way, which is really taking a look at the total return performance of the NASDAQ, right, technology versus MLPs over the course of the last couple of years. Now, this is a total, so everyone understands, this is a total return index. It includes the dividend income, right, the actual distribution income associated with MLPs, because if you looked at just price, you wouldn't see this chart. But Stephen,
Right.
This is pretty remarkable, right, for the whole idea that, that what a relatively boring sector of the market that's just generating income has actually, as an index, outperformed.
It's energy infrastructure. And, we just talked about oil. It's going to have its influences on sentiment. But the fact that pipelines, toll roads, processing of natural gas in the United States is offering us an 8% yield. Real estate is going to be interesting in parts too. We've added some leveraged mortgage REITs to portfolios for a forward-looking double-digit yield. Now, we're not going to do this in isolation in portfolios. Broader REITs are offering 3.5% yields. I've got the bond market to do even better than that. But it just shows that some of these areas that in some ways, the one thing you can't have is if you're going to have a whole lot of AI and large language models filling up your data centers, is you're going to need power for it. So that's some area where we can get some exposure, and we think that it can do very well just on the basis of yield. Final point is on the next page. This has been another year in which the dollar has fallen some. It's probably going to have some counter trend bounce backs like today. But the broader picture, we had 15 consecutive years of US outperformance ending in 2024. In 2025, things changed, and you can see that picture at the right, how well defined those cycles are. The dollar here is still more than 12% above its long-term average, adjusting for inflation. If you believe that the Federal Reserve is going to be concerned about employment, right? Well, then the Fed could cut some more. Now, all of this combined with some pretty good industry growth, our exposure to technology in Asia, for example. These are things that can get us some outperformance. And year to date, the outperformance of non-US shares is 8 percentage points in this young year. It's not going to stay that way entirely through the year, but we think, again, that we can get both some diversification and some strong returns for international holdings. And in terms of a broad portfolio of stocks and bonds, we've got 21% of the whole portfolio now in international equities.
Right, and I think it's important that we, look at the international investment, and you'll see this in the article that we recorded in this week in Barron's, that a lot about why we like international is not just the dollar, but an actual shift into where profits are going to be made in the future and relative valuations that will allow us to do well. And you can see that in the left-hand chart, where not only have these markets outperformed in U.S. dollars, but they've actually outperformed in their local currencies as well. So this for us is a trend that we think is going to be increasing potentially in terms of our exposure to international in our portfolios over the course of the year. Let's go to the next slide. So when we take a look at the CIO group portfolios right now, as Stephen mentioned, our medium risk portfolio is 21% non-US in our equities, right? We have exposure to gold and Bitcoin that we've maintained. We've got a 2% exposure to emerging market local bonds, which give us both higher yield and also exposure to non-dollar assets. We're overweight in certain areas. We have not changed our overweight in cybersecurity, in healthcare, in software, in energy infrastructure. We're underweight in small cap, which has had a great run, but I think it's, as I said, temporary in our last things. And when we talk about overweights in bonds, in treasuries, and also in short and intermediate duration credits. So this portfolio, this balanced portfolio last year, actually with a 32% exposure to fixed income, came very close to
38%.
the S&P. 38%. Thank you so much, Stephen. 38% exposure to bonds actually, almost performed as well as the S&P. And what's interesting, when we take a look at the portfolio this year, that continues, by the way, Stephen, which is our contributing factors, right? The things that are actually allowing us to outperform a little bit are actually those that are diversifiers in our portfolio right now.
That's right.
Great.
So international equities, some of these yield assets, healthcare, there'll be times when it settles down, but it's the industry that has performed the best during the bust periods, and we want to again have some exposure to its undiscounted growth. Again, within smaller companies, profitable mid-cap companies, or even profitable small-cap companies may play a role. But what we're not investing in, again, would be the companies that are unprofitable and small. You've had separate presentations from us on taking a long-term view of venture-type investments. The Russell 2000 is not a venture investment.
That's exactly right. So thank you very much for joining us today. Obviously, we're in a market that is in transition. Our portfolios are in transition and are changing their very character by what we're putting in them. By having exposure to sectors like healthcare, by adding mortgage REITs, by adding MLPs, we're actually adding diversification and the ability to make profits as the markets basically evolve. Thank you for joining us today on The Point. Stephen and I look forward to seeing you next week. And of course, you can read our written materials, which we issue every single weekend in The Point, our editorial. So thank you, Stephen, for joining me. I'll see you next week.
Thank you.